Hey, it's Josh again. This week, we're going to be introducing a friend of mine, Shari Saba, and she is a fantastic friend, colleague, and also a very well-informed mortgage lender. She's going to help us answer a few questions that I have seen come up quite often and have experienced come up a lot with my buyers. So I wanted to go ahead and introduce Shari today. Shari, nice to see you.
Hi, how you doing? Thanks for having me.
Yeah, she'll be with us the next couple of weeks. Shari, today I think the thing I want to ask you about is FHA versus conventional loans. Can you just describe a little bit about the difference between those two things and what the pros and cons of each might be?
To start off, the major difference between FHA and conventional loans is what's best suited for you. Conventional loans are more geared towards people who have really great credit. FHA loans are a lot more forgiving for people who have less than perfect credit. Now, when I say really great credit, 740 is the gold standard to have as far as a credit score. So when you drop into maybe the upper 600s, mid 600s on your credit, doesn't mean your credit's bad. It just means you have a little bit more work to do. FHA might be a better way to go. Conventional loans is really my first stop shop for people who have really good credit because they're less costly. The mortgage insurance, which is called PMI. PMI is something that all lenders have on a loan if you do not have 20% to put down. That does nothing for you. It protects the lender in case you decide to stop paying for your mortgage. So the PMI on a conventional loan will drop off when you gain 20% equity in the house, as opposed to an FHA loan where that mortgage insurance stays on, and that's part of your payment. That mortgage insurance will stay on for the life of the loan or until you refinance it down the line out of it. The other big difference is, so there's a few more costs. The other big cost on an FHA loan versus a conventional loan is FHA, which you've heard the word HUD, they're kind of the same thing. They charge a funding fee, and it is 1.75% of your loan amount. So obviously, if your loan amount is $100,000, they're going to tack on another $1,750 onto your loan amount. It's going to piggyback on your loan amount. It's not a cost you have to bring to closing, but it's a finance charge. So you finance a little bit more, a little bit more on the loan, and that's part of what you have to pay off when you're paying off the loan. So they're probably, conventional and FHA are probably the two most done loans out there. So they're both great. They're both fixed. There's no prepayment penalties. You can pay them off anytime. But FHA is a little bit more forgiving for less than perfect credit. Okay. The other thing is for first-time home buyers is that the FHA loan is really the one that ties in with the first-time home buyer program. So for those first-time home buyers that are needing some help with down payment assistance, sorry about that, that's usually the way you're going to have to go is on an FHA loan. Also, the one big difference in FHA and conventional, there's something that we look at when we are assessing a borrower's ability to borrow. And we look at your debts, and we look at your income, and then we project a monthly payment that you're going to be comfortable with. And that creates what's called a debt-to-income ratio. On conventional loans, there's a percentage we have to stay under. Ideally, they want you at 45%. We can push it up to 49%. But on an FHA loan, I can push that up to almost 55% on a regular, not a first-time homebuyer program, but just on a regular FHA loan. So sometimes that's more workable for people who have a few more debts.
Sure. Okay. And thinking about like the gold standard of credit scores, that's something that I find people asking me about pretty often is my credit score good enough? What's sort of like your the ranges, or what's the cutoff for a conventional? How do you normally address that?
Well, there's not really any. Well, you can't do a conventional loan below. I think it's 620, and believe me, you would not want to do a conventional loan at 620 because what happens is Fannie Mae and Freddie Mac, who are your big people that your conventional loans go through, For your credit score starts at 740. As far as anything above it, we don't care about, but 740. For every 15 points that your credit score drops below 740, they have what's called a risk-based pricing adjustment, which means your rate's going to get higher. Your rate's going to get higher. And by the time you get down to 640, whatever, it could be an ugly interest rate.
Right.
And obviously a higher rate means that you qualify for less. Now, there could be compensating factors in there that make sense. I mean, I think about a month ago, I just did a loan on a guy, and he was putting down a huge chunk of money on the house. He was putting down like 40% on this house. And because he was putting down so much more, it kind of compensated for the credit score, because his down payment was higher, so it allowed me to give him a better interest rate. So it made more sense for him to go conventional, and he still got a great rate because he had such a big down payment. So everybody's situation's different as far as that goes. But ideally, you're going to get a much higher interest rate with the lower credit scores on conventional. Whereas on FHA, you're pretty much going to have somewhat the same rate, unless once your credit score starts to drop maybe below like 670 or down to the 640, 630 range, the rate's going to go a little bit higher, but it's still going to be a decent rate. Way better than if you had that same credit score and try to do conventional.
Gotcha.
Much better.
Yeah. Okay. And FHA and conventional are the most common ways to finance a home purchase. Would you want to go over any common other loan types or other ways to buy a house for people that may not know?
Well, USDA loans are great. If you live in an outlying area, I mean, they're great. That's 100% financing. Once again, they're very restrictive on your debts to your income ratio. They like to stay on the lower end, but great loan product because no down payment, and the mortgage insurance is pretty low on it. It's calculated pretty low. But you have to be in a specific, the property has to qualify for USDA, and we looked that up, and there are income limits depending on your family size and the county that you live in.
Right.
Their first-time homebuyer program, the one that goes through the Tennessee Housing Development Agency, THDA, you have to 640 credit score. That's right now, they have a 2.75% fixed interest rate on that program.
Wow.
And they give you up to $7,500 towards, that's max now, $7,500 towards your down payment. If your loan amount's above, I think, $150, they just readjusted it. Below $150, I think it goes to $5,000. But, I mean, 2.75 is a sweet rate.
Yeah. Yeah, well, and if you're buying a house for the first time, that's an amazing rate, and a great program too. It does change a lot, so it's one of those things that you kind of want to check in on, when it's time to buy, and figure out what the specific standards are for that time.
Absolutely. Other than that, it's VA, and you've got to be a vet to have a VA loan. Those are great loans. Love doing VA loans, but you have to be a vet to do a VA loan, and that's also 100% financing. So FHA, VA, conventional. Jumbos, when you're getting into the more expensive loans, those are really tough. Very, they look at everything.
Right.
Everything.
Yeah. Okay. Well, I think that basically covers the FHA versus conventional, and also talks a lot about how to get into those types of loans.
Here's one thing I wanted to mention, because a lot of people don't know this. Student loans. Student loans are treated differently on every single different loan product. Where if I've got, and I don't care if your student loans are deferred or not, there's going to be a payment that you're going to qualify with no matter what. On an FHA loan, if no matter what they're going to use, even if your payment isn't 1%, they're going to use 1% of whatever your student loan balance is. On a USDA loan, they'll use potentially 50%. Okay. On conventional loans, if the payment reports, they'll use that payment that's on the credit report. So a lot of people I run into, especially first-time home buyers, they have those student loans, and they go, but it's deferred. And I go, but there's a payment that counts.
Yeah.
And sometimes that can, mess up a person's qualification, unfortunately.
Yeah, unfortunately. Well, and it's one of those things where you just kind of want to, it's a thing to check in on and say, if you have student loans, it's not going to prohibit you from buying a house,
Yeah.
but it is going to factor in to how you qualify and what you can qualify for.
Absolutely.
Right?
Absolutely.
Great. All right. I think that's a good first episode for us. We're going to do a couple more topics over the next couple of weeks, so stay tuned, and we'll see you next time.